Hey, I'm Max Weisbrod, founder of Baton, a free matchmaking service for early stage founders to find executive talent. Today on Fractionally Speaking, I'm speaking with Blake Harber of Blake Harber Consulting, a firm that focuses on early stage go-to-market strategy and consulting. Blake, can you tell us a little bit more about what y'all do?
Yeah, absolutely. Thanks, Max. I work with early stage B2B SaaS founders and small sales teams that are looking to build repeatability in their go-to-market motion. There's a lot of challenges in this transition between founder-led sales and then hiring their first couple sales reps. And a lot of founders tend to they want to default to hiring either that VP of sales that's done it, and most VP of sales have actually never seen that stage and transition before, or they end up hiring SDRs and then all of a sudden they're an SDR manager and they've never managed SDRs in their life. And so there's a huge gap there, and I help bridge the gap there, help build repeatability around top of funnel and the early go-to-market function so that it gives a founder the confidence to start to scale a team around it.
So when we say early stage, that can be a little bit squishy depending on who you are. You know, if you are like somebody who is starting a business from scratch, early stage can mean basically like no sales, but that's not what it sounds like you're talking about. You already talked about some of these developmental markers, right? There's a sales process. It just happens to, center around the founder. They have like some sort of source of leads already in place, right? If they're talking about SDRs. And how do you, like, when you're talking early stage, like, what's the bare minimum in place for somebody like you to be able to come in and deliver a transformation?
It's most helpful when the founder has sold themselves to at least a couple $100,000 of revenue. And it usually comes when the founder starts to think about, should I be hiring a sales rep or the next sales rep number 2 or 3, or should I be hiring that VP of sales? And without that foundation, it's really hard to extract the sales motion from a founder's brain. I talk to a lot of founders that are sub 100,000 of revenue and have 3 customers. Those are really, really hard. Even 500K is hard. There's still pre-product market fit challenges that got to be fleshed out. But ultimately, this go-to-market motion typically resides in the founder's brain. The founder doesn't know how to translate that into a playbook that an SDR straight out of school could come in and execute on. And in order to scale past 1 and 2 million, that playbook has to be in place. Otherwise, what happens is they start to hire all these sales reps, 3, 4, 5 sales reps, and they get 6 or 9 months down the road. And maybe one sales rep got lucky and hit a decent number that makes the unit economics make sense. But then they're kind of back to the drawing board in terms of repeatability because the playbook actually never got built, if that makes sense.
And what drives a founder to reach out to you? What problems are they talking about in that initial meeting?
I'd say 90% of the time, a founder has already gone through this full cycle. They've gotten to 500K revenue. They started to build a sales team. They hired that VP of sales or CRO and ultimately turned them over after 9 to 18 months. It's a really, really costly mistake. And at that point, founders typically have that light bulb moment of like, something else has to happen here. I need to do this differently. And that's where most of my conversations start, is when a founder has gone through that experience, because it's painful and it's extremely, extremely expensive. And so it's critical to be able to find someone that's seen this stage before, because most sales leaders have never, ever seen the stage before, let alone the sales reps that you're hiring. And the ability to extract that sales motion and start putting it into a playbook that's repeatable is extremely difficult.
So what questions should these founders be asking when they're talking to a potential sales leader to come in and organize this part? Because I mean, we've got things like, some companies are selling $3,000 deals and some companies are selling $3 million deals, which, seems like it would be like completely different motions, completely different leaders. So how do you think about that?
It's critical to understand their experience that is related to the stage you're at. And the ARR is just, it's one indicator. What I really care about is understanding the evolution of the sales motion at the companies they've been at previously that can really dictate how advanced they are in developing the playbook. They might have joined a company previously that was at 7-8 million, but the evolution of the playbook was in its infancy. There was no playbook still. And that can be common. They might have also joined a company at 500K of revenue, and the playbook could be a little bit more advanced because you have a really strong go-to-market founder. That's much more rare. But so I think it's really important to initially understand their experience previously, and have they seen those early stages of what it takes to take something from really pre-product market fit and start to put this infrastructure around go-to-market in order to scale and do it efficiently. As we go into this economic downturn, like, you can't just throw heads at the problem and hope that it works out because we have unlimited runway anymore. And so that evolution and understanding where a sales leader has been, or a fractional executive has been and seen, is really, really critical, because you have to play this role of almost individual contributor also all the way up to an executive level, and be able to understand the unit economics of the business and what's going to make sense as you start to scale the team. And those people are really, really hard to find, because most have either seen the opposite ends of the spectrum, and the dashboard type sales leader, or the really, really early sales leader that has never actually seen the high growth stage.
Yeah, if you're used to coming in when there are already dashboards in place, you might not understand how things actually get instrumented in the first place.
Yep.
So you talked a little bit about runway. We're talking about companies that have already, failed in a transformation before. They've brought in a VP of sales who had the wrong experience, wrong expertise, and wasn't set up for success, or wasn't able to succeed in that spot before. How are these firms capitalized? Are these like venture-backed firms for the most part? How are they funding, this talent?
Yeah, it's interesting, because actually my customers are, I'd say 50-50 on venture-backed or bootstrapped, and both have the same challenges. I think the expectations of growth differ a little bit. The bootstrapped are typically a little more conservative in their approach, but have still gone through the same experience. And a lot of times the bootstrap ones have hired the venture-backed high growth executive that is used to throwing bodies at a problem, and then have had to reset and kind of rewind after they've turned them over. And the venture-backed have a little more room to run, or at least to test things faster. But ultimately, they're 50-50 in my experience so far on the go-to-market side.
So when we're thinking about taking these companies from a place where they don't have a playbook in place, they don't really have as much of a repeatable process, they don't have product market fit, how do you know when a firm does get to that product market fit? What are the indicators? Is that a single state? Like, is that a place where they stay? What does it mean functionally to them?
When I start working with an organization, the number one thing we start to look at is top of funnel and repeatability there. More often than not, there's not a repeatable motion on top of funnel. And what that looks like is when I can sit down with a founder and say, how many net new meetings have you had in the last 30 days? And what happened to those meetings? And then how did you find those meetings? If we can't answer those questions and those numbers generally make sense for that business, then you're going to have a really, really hard time scaling any go-to-market function. And I don't care if that's direct, I don't care if it's through the channel, partnerships, whatever. There needs to be consistency and repeatability on that top of funnel first, because once we solve that problem, the rest of it becomes a hell of a lot easier, especially in this macro environment, is let's solve that problem. So I spend an enormous amount of time with the organizations I work with, finding repeatability there and building that muscle. And then as we start to see early indicators that that's working, and I'll give you an example. SMB, mid-market type, what's called $15,000 ACVs, higher velocity, higher volume type sales motions, you should be setting one meeting a day net new. And if we can't get there, the unit economics won't make sense on scaling a B2B sales team that's going direct. It would be really hard to, if that makes sense. So I spent a lot of time on top of funnel and looking at building systems and process that a team can execute there. And a lot of that kind of funnels around this, understanding your ICP really well, understanding your target persona, because those are different. Your ICP and your persona are different. And then your target messaging to that persona. And there's a lot of work that we have to do there to get really clear about who we're going after, what person we're going after in that organization, and what we're saying to them that's going to resonate.
It's kind of like you talked about talking about the person inside of that organization, the actual, there's sometimes the economic buyer isn't the same person as, who's making the buying decision. A lot of things can happen there. I know that from my own business, right, we figured out through testing basically that, we reach out to 100 people on LinkedIn. Out of that 100, we book like 3 to 5 meetings. And off of that, we get to like one pilot deal, and the pilot deal just doesn't close, right? So we repeat that over and over again. We go through the objections, right? We try to make iterations on the offer in order to get something that actually closes. Really, really painful, brutal process. So you're effectively guiding them through this of building out, and here's how we reach, here's how we get our unit economics to work for this, here's our CAC, and here are the experiments we're running at every step of this in order to increase the how many transition from one stage to the next, and hopefully close and increase that close rate. Is that accurate?
Yeah, that's right on. I mean, in your example, it's a phenomenal example, right? And there's a few questions that you want to be asking yourself in that. It's, am I reaching out to the right person, and is my messaging right, and the right person? And is your target persona right? Profile. Right? So what segment of a business am I looking at? What are some characteristics? Are they all venture backed, or are they 50-50 bootstrapped and venture backed? Which ones are taking meetings? And so dissecting all these details of who the ICP is, and then your target persona and your messaging to that target persona. And ideally, you can then get to a point where you're reaching out to 100 connections on LinkedIn. You might get 10 responses then and get 2 into pilots. Those are the micro details we're looking for, and we want to start to test and get really confident in, if that makes sense. Because if I have that, then I can understand repeatability and say, okay, at least we know we can get 2 into a pilot and at least close 1. If I know that, we're in a really good spot, because then it's just okay, how much can we do here? What does the TAM look like? And what do the unit economics of a sales rep need to be? And the function of that sales team, how do they operate? How do we do this as efficiently as possible without hiring a bunch of AEs at $160,000 a year to go in and sell $8,000 a year deals?
You have to sell a lot of $8,000 deals in order for that to make sense. So what differences do you see between these bootstrap companies and the venture-backed companies when it comes to thinking about customer acquisition cost and potentially like cash cycle?
Venture-backed are typically, they're much more able to test faster. We can test multiple channels at once pretty quickly, and ultimately we could burn more money faster. The bootstrapped ones are just much more conservative in that. And it's interesting because a lot of times they've been around a lot longer. They have less of a product market fit challenge. And therefore we can focus in on one channel, typically direct, that we could start to scale. They just haven't necessarily nailed that transition still, if that makes sense. So yeah, so venture backed, I mean, the beauty of it, that's my whole background is venture backed, and you can typically test a lot faster in a company that might be 1-2 years old, can ideally, if we could throw some money at different channels and start to figure out what's going to work faster.
I know in my own business, I like for newly converted deals to just pay for themselves, basically immediately. When I worked in a venture-backed firm, we were okay with like a 6 or an 8 month payback period on those deals. Like we had the cash to play with. It seemed nice. We get testimonials up front. There are a lot of benefits for a firm that isn't worried about, cash in the bank, to just being able to take those clients and then have them pay back over the course of like 2/3 of a year. Which now it's when I'm playing with my own money, it's like, this is insane. Why would I do that?
Yep.
So a little bit back, you talked a little bit about the difference between like the ideal customer profile and a persona. Can we dig a little bit more into that, especially for, non-GTM founders? How should they think about the differences between those two things?
Yeah. A lot of founders, they start to correlate their TAM or what they're pitching to a VC as their ideal customer profile. And what that typically sounds like is we sell to restaurants and there's 1 million restaurants in North America. It's like, that's great. But I have sold to restaurants for the last 2.5 years and now work with a lot of companies that sell to restaurants specifically. There's fast casual restaurants. There's quick serve restaurants. There's, you have franchise restaurants. You have corporate owned restaurants. You have independent restaurants. And then the segment of each of these restaurants and ownership structures are very, very different, the way that they operate. And so defining your TAM or understanding of your target ICP, it more often than not needs to be chunked down 4 or 5 more layers. And that scares founders a lot of time because they think, oh, well, shit, my TAM is actually only $10 million. That's okay in the early days. You have to get over the fact that your TAM might only be $10 million to start with. But what happens is, and I see this all the time, they start to hire sales reps and the sales rep is now going after the TAM of restaurants. And they're calling all these different restaurants, but in reality, the product, you really might only have product market fit in quick serve restaurants with owners that only have between 5 and 10 stores in these certain brands that are franchised in Ohio. Now all of a sudden your TAM is tiny, but if you can learn to narrow in that type of focus in the early days, it will benefit you greatly. And you can start to then build product and your go-to-market motion to expand that TAM over time. But founders they want to expand their TAM way too fast. And in reality, they need to focus way, way, way in and get really, really clear about their ICP before they start to think a hell of a lot bigger.
How many of these founders are coming in saying, we are a platform on day one with...
Almost every single one. Everyone wants to be, they're at 200K of revenue and they're a platform for restaurants, right? Like it's unrealistic. And then unfortunately, like you're a product guy, like it leads to really big product challenges because all of a sudden you're building for everyone in the restaurant space. And that's not real, right? Like the retail sector is the same. The tech sector is the same. Like there's such varying differences in understanding who you're selling to. And that has major product implications. And then all of a sudden you might be at 5 million and realizing that actually we built 3 different products. And essentially you have 3 different companies. I'll give you an example. Companies that are trying to do product-led and sales-led at the same time. You're going to build 2 different products because you're building 2 different motions. That is so unrealistic, especially in the early days. You need to just commit to one and decide on one, because saying you're building an enterprise sales motion, but you're also building a product-led is drastically different.
So a little bit earlier in the year, beginning of the year, I went through, and had 50 conversations with, customer success leaders. And that was like a big challenge inside of these organizations that are doing, $20 million to $100 million in revenue. Is they're saying, we've built around a sales-led motion, and we're trying to, move from that to product-led or, customer-led, whatever you want to call, these tech-enabled sales motions, where customers are onboarding themselves, they are taking advantage of incremental features, like all kinds of stuff like that. And the product challenges in doing that are tremendous. So for these sales-led organizations, usually like founder-led sales in like the sub $5 million area, what are they giving up? Like, what are they having to undercut in these mid to large deals on the sales-led motion in order to, feed a product-led motion? What are you seeing fall apart when they try to do that?
I'm not a product guy, but I've been on the receiving end on the go-to-market side of this evolution multiple times. It's going to take 2 or 3 times as long as you think it will actually take to potentially transition from a sales-led to a product-led, or vice versa. Honestly, you're restarting your go-to-market engine, and I don't think you can discount how long it will actually take to understand the buyer persona on the receiving end, which is probably drastically different than your end users that are actually self-serving or going into a freemium product, right? Give you an example of my sales team. They Scratchpad, very popular tool. Sales reps freaking love Scratchpad. It's annoying as hell because all the sales reps go in, my team, they adopt it, they use it. I never once have purchased Scratchpad. I love Scratchpad. I know a bunch of people there. They're great. But at the end of the day, I was a budget holder. My RevOps leader was a budget holder. And they had a hard time transitioning from this self-serve motion where sales reps maybe should have been paying for it themselves, which, to be clear, I had sales reps that would actually pull out their credit card and pay it. But ultimately, they were trying to figure out, to this day, their go-to-market motion and understanding who their buyer persona is, which is very different than their end user. As my team that used Scratchpad, I never once logged into Scratchpad. I could kind of tell you what it does. I know nothing about it. Ultimately, what I care about is like when my team's at scale is the dashboards and the impact that Scratchpad could have on the business. And so what that looks like in reality is 2 completely separate products. You're building for a Salesforce integration and like what buttons reps are clicking, but then I'm your economic buyer and I care about dashboards at that stage. When I have 20, 30, 40 sales reps, I want to understand the higher level what's going on. And being a product guy, you understand that those are 2 very different motions. I care about administrative controls. I care about locking features down, things like that. So that happens all the time. Is I think it's really, really easy to see like, cool, I have this HR tech product, I have this recruiting product that sells to retail or hospitality. And we support individual locations and store managers there, but we're going to sell to JCPenney's or Nordstrom's, right? Well, corporate Nordstrom's is a very different product supporting stores as opposed to the general manager that's in a store that really doesn't use technology anyways, if that makes sense. And so that transition is extremely difficult, and you're building a whole new go-to-market motion. All of a sudden, if you've built for corporate Nordstrom, now all of a sudden you're targeting a very different persona and profile of a general manager at a store level that doesn't really use technology and isn't used to buying technology, but needs to support individual users at a store level.
I've got a client who, some of their end customers, their largest, customers are franchisors, right? So there are some services that effectively, the value delivery is at the franchisee level, right? But when the economy starts to get choppy, the franchisor is looking at every vendor partnership, right, on their P&L. They're saying, hey, across all of our franchisees, we are spending this amount every year on this product or service. What are we getting from that? We have no visibility into it, which then becomes like a very hard conversation with the champions, where the champions at the firm are saying, hey, like I need to be able to answer X, Y, and Z questions. Dashboards. I need dashboards that show me at an aggregated level where we're getting value and where on the account we can make changes to get more value. Basically, and that is a completely different product. It's a completely different level of instrumentation. There's a ton of expensive product work that has to go into it. And meanwhile, if you wait for it to get to that point, you aren't going to be delivering anything until 3 or 4 months after that renegotiation is done.
That's right.
Which is a brutal dynamic to have inside your team between the go-to-market leaders and your product and engineering teams.
Yep.
So I want to transition here, though, this is like really interesting because you've got something else that's really cool that you're working on. Fractional executives or, executives for hire, anything like that, we're service providers, right? And there's a relatively low multiple on what you're able to get on that. And, we're usually providing transformations with little to no, upside, capture, right? Value capture. It's usually like a retainer or hourly. You're doing something different. Could you tell me a little bit more about that?
Yeah, maybe I'll rewind a little bit and tell my experience a little bit. So I left my most previous company in September of last year and planned on taking the rest of the year off. I got 4 little kids, an amazing wife, and haven't emotionally seen them for years because I've been building high growth venture-backed startups. And I actually plan on going back full time to the next venture-backed startup to scale again. And I met about 30 founders over the course of November last year. And it was the same story over and over again. I hired a previous sales leader. It didn't really work out. We parted ways. Now we're back to the drawing board. And they were looking to hire me as their next sales leader. So I recognized this huge gap, which is ultimately what led me to consulting. I decided to go all in on consulting early December of last year. Had no idea what to expect. There wasn't really content out there about how to do this, at least that I could find. I had no clue what to do, how to do it, how to structure contracts, how to find customers, whatever. I ended up building my entire consulting business in public because I had so many people that were interested in doing this. Fast forward, it's been 6 months, essentially. I've come from 0 to 40K a month pretty consistently. And I still have time, right? Like I have emotional energy to keep going. And ultimately, over the last few months, I've had this decision that's been really hard, which is like, I could go get more customers for sure. And I could probably scale this to $1 million a year. But ultimately, I'm trading my time for money. And this is not an acquirable asset necessarily. Like maybe it is to some extent. And don't get me wrong, you totally could. I could build a consulting practice around this, I'm sure. But what I have, the main reason I went consulting is like, it allows me flexibility and autonomy to do what I want every single day. I wake up and choose what to do that day. And that's what I love about entrepreneurship in general. And so I've started now to go down this rabbit hole of acquiring a business. And this is probably not going to be a software business. In fact, I'm going the opposite direction. I'm looking at 10-plus-year-old businesses that are typically service-based businesses, transportation, logistics, landscaping, and a few like distribution companies that have been around a long time that don't have product market fit issues. There's obviously product market fit, and a lot of these are doing anywhere between 800K to 1.5 million in EBITDA every year. And ultimately, my consulting business is what's going to fund an acquisition of another company in a very different sector that I can come in and bring what I have learned over the last 12 years in tech and hope to innovate and adjust what the company's been doing and drive top line growth, pay down the debt service on it, and then over the course of 3 to 5 years, 100% own an asset that is now acquirable or sellable, right? Like I could roll it up to a private equity firm for $5 to $10 million, depending on what top line and EBITDA is. But so I've been passively searching for 6 months. I've been heavily searching for the past 2 months, and I've documented all live. I have a lot of people that are very interested in this. I write about it publicly, weekly on my Substack, just blakeharber.substack.com. It's been a really fun journey so far. A lot of learnings.
So obviously, like if you're looking at acquiring these service-based businesses, one big problem with acquiring service-based businesses is usually it's like, some middle manager coming in from, some corporate, thing saying, I'm not doing corporate anymore. I'm going to go run my own business. I'm going to buy something. They don't really know anything about how that, type of business works. They maybe don't have like experience running a transformation. What is like the core of the opportunity that you're seeing in this space that allows you to come in, buy this asset that is, working for the current owner, and then providing a transformation that is going to make it dramatically more valuable?
A lot of these businesses, they've been around a long time, and a lot of them don't even have websites. A lot of them are just word of mouth referral business. There's really no direct sales, or a lot of them are they're owners that are just looking to retire, and they haven't cared to grow the business anymore. It's been doing 800K of EBITDA for the last 8 years. They don't care to continue to grow it, because taking it from 3 million in gross revenue to 5 or 8 million is a big jump, and takes a lot of like operational excellence to scale that. On top of that, a lot of them don't have like general standard operating procedures. They don't have playbooks on how to basically back themselves out of the business as an owner a lot of times. And there's a lot of opportunity there to come in. I mean, hell, you can take debt, 90% loan to value, even on some of these with an SBA, and still cash flow really healthy businesses and reinvest every penny back in the business or pay down debt service. And all of a sudden be a few years down the road, even if you don't grow top line, and own the thing outright. And it's a multi-million-dollar asset. I'm simplifying it a lot. It's going to be a hell of a lot of work. Don't get me wrong. And there's unique challenges that I understand going into it, but it's a formula that works, right? Like my father owned a small business growing up, never had a website. Literally, like all of their AR and AP was on paper in filing cabinets. And this was a business doing $20 million a year in top line, and he owned that thing for 35 years. The irony is now I'm actually looking for that exact business to go acquire. He's sold it off and exited the business since, but those are the type of businesses I'm looking for that have huge opportunities.
Really incredible. So I think that we are just on time here. So Blake, thank you for joining me. Where is the best place for people to find you if they want to reach out, get connected?
Yeah,
or follow your journey.
LinkedIn's the best place. I write on LinkedIn every day. You can reach out to me. I will eventually get back in my messages. And then Substack, blakeharber.substack.com. I document my journey live. I'm an open book, man. I'll tell you exactly how I'm finding customers, what I'm doing with them, all my details. So there's a lot of fractional executives that want to do this, and that's ultimately like why I started building it publicly, is in hopes to help others reduce their dependency on a single employer. So Substack or LinkedIn is the best way.
I really do think that fractional is going to be the future. I think
Totally.
that a lot more, labor is going to be, split across, and that way we're going to be able to capture more of people's talents.
Yep.
Well, thank you so much, Blake, and have a great rest of your day. Great chat.
Thanks, Max. Appreciate it.